Welcome to the tonight's YouTube Live. Very excited to have here with me Darryl Brown, who was my first guest. We tried having you on, but the audio, I didn't have my tech solution sorted. But now you're back, you're here, and I'm so glad to have you on the show tonight.
I think I'm readable now. I think people can hear me now.
Yeah, hopefully that audio, if we can get like a
Awesome.
thumbs up from the chat, we'll get. But I think everything should be good to go. That I solved the tech problems, and really happy to have you on tonight, Darryl. Really, I think you do bring a lot of great expertise. Tonight we're going to be talking mostly about bonds, so that's going to be sort of the big focus is bonds and bonds ETFs and all those different things. And so I'm just wondering if you can just give a quick little background to the audience, just so they get a sense of your background, sort of on the financial side. And then from there, we can dig into the market overview. We'll just kind of look at what's happened in the markets last week and then jump into our conversation about bonds.
Sure. So currently, I wear a couple of hats. I work for the firm that I founded called You and Yours Financial. I'm also the director of portfolio strategies for Spring. Tim obviously knows I work with him and his clients. And before that, I worked for Sun Life Investment Management, and they have a huge fixed income portfolio managing money for life insurance companies, for pension funds, and I was on the investment management team doing research primarily on the energy and infrastructure sectors.
So we were
Uh,
talking, this was like, huge portfolios, like
yeah,
multi-billion dollar portfolios.
yeah,
On the debt side, infrastructure and energy, probably not, and that you've got a bit of an environmental sort of background or focus as well, because
yeah.
you also I get the sense that it wasn't the most fulfilling work doing bond rating, analysis on those sectors.
I mean, it's incredibly interesting work, especially at the time the pipeline sector, which about 8 to 10 years ago was very quietly getting into to issues around trying to expand capacity out of the oil sands. So being at the forefront of what a lot of people saw a few years ago, which is the blow up of the issues around Keystone XL, even Enbridge's projects like Northern Gateway. Those were
Yeah.
all kind of quietly brewing in the background. You could kind of see what was going to come a number of years ago. So it was super interesting from that standpoint. And I think the part that became a little bit frustrating is that you're in, an institutional environment, and the sole focus is how to make money. There aren't broader considerations about, climate risks or environmental concerns. We didn't really pay attention to that. And
Yeah.
that was something that was a huge interest to me. So that was kind of where my interest sort of started to wane. But before then, it was incredibly interesting.
And then from there, you also founded a cool little company that's a zero emission delivery service. Is that
Yeah.
right?
I did, which is going kind of nuts right now. But it's called the Drop Distribution. It's a zero carbon, zero emission distribution company here in Toronto. We operate on an urban consolidated basis, which means we basically aggregate a lot of deliveries from a number of different clients, and then we basically deliver to the east side of Toronto one day, and then the west side of Toronto the other day. And so
Amazing.
there's been a lot of interest as unfortunately retail storefronts have been
Yeah.
looking for other channels to get their product out. We've just been getting a lot of interest. So yeah, number of hats. That's an additional one that I've got,
So,
which is
so you're an eco entrepreneur. You're a fee for service financial planner. The arrangement that we've got that I had sort of brought you on, expecting that before COVID hit, we were planning for the Green Living Show, and I was expecting to get just absolutely slammed by client demand. And so I
yeah,
sort of brought you on and kind of trained you up on the process that I've been using with clients, just to be able to have that overflow, so that if there were more clients that I could service, that I wouldn't have to turn them away or have a 6 month waiting list, that you were there able to help those people. And certainly I think that it's my hope that as you're learning more and exploring and having a lot of fun on the ESG side of things, that certainly I think there are a number of ways in which you're going to be a very busy man
yeah.
over the next little bit. So I'm going to hope to grab as much of your time as I can. So okay, so let's shift the conversation to bonds. Really when it comes to bonds, there are a wide range of options. But the standard benchmark that we tend to use in a lot of these sort of couch potato portfolios is something like XBB. So I'm just going to bring up XBB, which is the iShares Core Canadian Universe Bond Index ETF. This would be a very standard part of your bond portfolio. And so like my first question, Darryl, is that, traditionally we would say we kind of had this view that this general rule that the bonds should be the percentage, that the percentage of bonds inside your portfolio should be consistent with your age. So,
Right.
I'll speak for myself, right? I'm going to have to do the math now. I'm turning, 38? So I'm 37 years old now. And 2020 makes it easier for me to do the math there. And so roughly as a general rule, I should be at about 37% bonds. That would put me at 63% stocks. Now, obviously, there's some wiggle room there that I can look at my risk profile that, on the one hand, I'm an entrepreneur, so, my risk is a little volatile. I don't have a huge amount of insurance, because I run my own business. So, a little bit, maybe take a little bit less risk there. On the other hand, I am engaged. So, my fiance is, does have a nice stable job, and that it looks like there will be some benefits and insurance coming through with that. So, it's the type of thing where I would be able to sort of keep myself in a range. I would say the lowest I would go if I wanted to be very risky, but really the lowest I would go, it would be about 30 or 25 percent, 25 to 30. That would be the low end. At the high end, if I wanted to be more risk adverse, probably about 45. I don't think there's any sense for me to be more than 50% bonds in my portfolio, but really depending on that risk profile. That was the rule for so long. The issue is that right now bond yields are just so low that when I look at interest rates, like here I am on XBB, this would be a standard bond ETF, and I'm looking at the weighted average yield to maturity, which granted is like a low ball estimate of what I would expect to earn on this bond ETF, but I'm looking at 1.5%. So, it's just a bit of a tough pill to swallow to think that, 37% of my portfolio should be in something where really I only really expect to earn 1.5%. So help me understand why this is still a good idea.
So a couple of things. When we talk and when we communicate with clients about asset allocations, I think you describe it really well. It's not meant to be hyper prescriptive and strict. So if you decide you want a 65-35 portfolio, doesn't mean you have to rebalance it to those exact amounts every single day, every single week. There are ranges, and I think those are healthy to have. 5%, 8%, 10% on either side. Those make a lot of sense. Now, going back to the point about interest rates and bonds, the rates are low now. Coming into 2020, the rates on the 10-year Canadian bond were 1.5%, and I thought those were extremely low. We're at 0.5% right now.
It couldn't go any lower, Darryl. It
right?
couldn't go any lower.
That's what I said. That's what I thought at the beginning of 2020.
Yeah.
But you know what? That was said in 2016, and by large institutional investors who do it for a living, who manage large sums of money. And it was said also in 2013, and it was said in 2011. Like, you get the picture. Like, there have been so many points along the way where people have gone, oh my God, bonds are a joke. Why would you ever have it in your portfolio? They don't make any sense. They're not going to make any money. And there's two components to earning a return on your fixed income or your bond investments. Number one is the interest rate, which at times could appear low, whether it's 3 or 4 or 2%, whatever it is. That only comprises one part of your total return for a bond. The other part is the fact that your bond price can actually increase over time. When I started working on the institutional desk and I opened up the portfolio, there were bonds in there that had appreciated 60%, 60, from when they were purchased. These are long-term bonds, which coupons, and because interest rates had declined so much, the bond prices have gone up. And so for people who aren't aware of the relationship between interest rates and bonds, interest rates go down, the price of bonds goes up.
That's right. So let's just break that down. Just because it's a tricky concept and it's a really important one, is that the idea here is that bond, the value of a bond versus the interest rate. So if I buy
Right.
a 10-year Government of Ontario bond that earns, I don't know, I'm just going to say 2% a year, that if interest rates go up, all of a sudden my 2% isn't that someone could buy that same bond now and earn, let's say, 2.5%, right?
Right.
So all of a sudden my bond that's only paying 2% isn't worth as much. Sell it, I would be selling it at a discount in that case. So
Right.
the value of my bond goes down as the interest rate went up. And the flip side is true, that if my 2%, 10-year government bond, if interest rates fall even further, all of a sudden my 2% is like awesome, like I'm getting 2%, it's worth more. It starts treating at a premium.
People pay premium. Yeah.
So, helping people understand that, there is that little difference. And I had XBB up, here, and I can just show people just that it was up. Where was it? I had it here. The year to January 1st, this very traditional bond ETF is up 5.5%. So when
Yeah.
the stock market, with the stock market down, the value of our bond ETF is higher. So really,
Yeah.
it is that what we would call a negative correlation. So if I just chart over the last 6 months, XBB, and I'm going to compare it to, I've been using XAW.to lately as my sort of benchmark in Canadian dollars. This is the MSCI All Country World Index, but minus Canada. There isn't one that's like includes Canada. So this is the one that I tend to have here. And let me do it for a year, because I think that'll tell the story. That basically, as the stock market had been doing well, the bond was flat, and if not, actually down a little bit. Now, not the interest rate. This is the share price of the bond. Okay, so this isn't the interest rate that we're getting. This is the if I wanted to sell my bond. As it went up, the value of my bond was down. Now, there are some interesting points where, they both did go up a little bit, just before the crash, but it was really once the crash started, that's when the value of our bonds actually went up. Now, there was a very, very scary moment. And this was, I've got it here, and this was March 18th. And this was the moment when our bonds came down as well as the stocks crashed. And I see you nodding because I think you remember this week in March, because we were all sort of collectively holding our breaths, because this was a very bad signal that stocks and bonds both falling at the same time. Now, obviously, bonds didn't fall by as much, but they did fall quite a bit. That's when we had this government intervention, and not so much by governments, but from central banks. So, here in Canada, we have the Bank of Canada. It really was in the US, the Federal Reserve, that they moved much more quickly than they did in 2009. And they started buying bonds. And literally the Federal Reserve, the organization in the US that is essentially allowed to print money, I'm using air quotes for print because it's all electronic now, but they're able to snap their fingers and create money out of thin air. And they use that cash to inject it in the bond market to be able to have that liquidity, which meant that bonds came back up as people got more confident, while stocks did come back up as well during that bounce up. So again, they did sort of move in tandem there for a while as well. Now we're at a bit of a funny point, I think, in my mind, because really what it comes down to is the risk around bonds. And I'm going to split it up a little bit because I want to talk about corporate bonds and I want to talk about government bonds. And just so that people know that this XBB, this standard one, this is a mix of both government and corporate bonds. So I can show you the breakdown by sector. It's about 37%, 33%, or 34% federal, and then the rest. So about 70%, 71% government, and then about 29% corporate. And so that, when we look at the difference, in my mind, these are sort of two separate areas that I think coming out of this, we should talk about them a little bit differently. And so, in terms of the corporate bond market, Darryl, what is your sense? What is your feeling around corporate bonds right now?
So I think the good news for the majority of the indexes that appear in bond ETFs, we're talking about fairly well rated and good quality bonds. They're not high yield bonds, which are, or in other words, junk bonds, which have below investment grade ratings. But
Okay, now I need to stop you just because I want to break this down, and I've got it
yeah,
on the screen because you're using some terms here. So in terms
yeah,
of these credit ratings, we do,
yeah,
and I've got the breakdown here within this ETF.
yeah,
AAA would be like your highest rated. This would be your Government of Canada, safe. Like if this goes down, like we've got bigger fish to fry. And
yeah.
really, am I right in assuming that I think with this credit score, it really is about the default risk, the risk that the organization is going to go bankrupt and default on their debt, because this bond is like debt. I'm loaning money to these government and corporations, so that this kind of assesses their likelihood of going bankrupt. Is that right?
That's right. Right. Absolutely. And so when you're looking through the actual holdings of these bond ETFs, the corporations in there, in addition to the governments, the probability of default for them is very low, or they have, in other words, they have a very high credit rating. So
And let
there's,
me just, forgive me, but just a high credit rating. So the lowest it goes here is triple B. So
yeah,
triple A safe is double A, single A, triple B, and then I think I'm right in thinking that triple B, that's like the lowest score to be considered investment grade, and that's
that's
a
right.
very specific expression. And what this means is that they kind of count as this thing called tier one capital, so that when federal banks or federally regulated banks need to have a certain amount of what's called like safe debt on their books, and that a lot of these foundations and pensions and like big pools, they're not allowed to own bonds that have a below triple B rating. And so when a bond has a double B or a single A, or I think triple C is the lowest, I think, that
Pretty
that
much,
those
yes.
are
Yeah,
considered
yeah,
junk bonds. And for a long
yeah.
time there's like the junk bond market, because they're so risk, they have to have a higher return, that investors demand a higher interest rate. And so it's been interesting to see the industry kind of spin it, and instead of calling them junk bonds, it's like, no, 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 these are high yield bonds because they have a high interest rate. But the reason they have a high interest rate is because they also have a high risk profile.
That's right. Yeah,
So what you're telling me here is that inside this, because it's all investment grade, because triple B is like the lowest it'll go, in terms of this bond ETF, that this is considered a fairly safe, investment. Now,
it is.
I want to come back to a point you made earlier, which is that when you were working in the industry, they weren't really looking at ESG factors. And
Right.
so, am I safe in assuming that, like, some of the companies that are in here that are triple B, they might be triple B by one measure, but for us, if we're looking at it through this ESG lens, there might actually be more risk there. Does that seem plausible?
Yeah, absolutely. If you layer on ESG scoring and ESG factors, there are companies that are included in some of those ETFs that, for either values reasons or because you just factor them in, and that you believe that the risk is significantly higher,
Yeah.
that you would not want in your portfolio.
So, and I'm just going
That's
to
a very
show
good point.
people this list just so that they can see. And again, this is sort of like XAB. So we get a lot of government bonds. I'm just going to sort it by sector. And so under communications, Shaw, Rogers, Bell, TELUS, again, all sort of investment grade big banks here. And then really it's when we do get into the energy sector that we start to see TransCanada pipelines, TransCanada, Enbridge, Suncor Energy. So, it's not going to be the lowest risk, but there definitely are pipelines in here. Husky Energy is in here. Obviously a lot of tar sands, a lot of pipelines. And so to me, this is kind of the big red flag here. And that now it's not a huge part of this portfolio. If we do look at the sector breakdown, energy is about 5.8%. Right? So not a huge amount, but it is in there. So obviously for ethical reasons and for risk reasons, it probably makes sense for people to consider there are now ESG bond ETFs. So if you did want that mix of government and corporate bonds, something like XSAB, which, year to date up 5.5%, almost exactly the same. The weighted average yield to maturity, 1.45%, still so low. But it is going to provide that sort of negative correlation, and that when we look at the sector breakdown, it's going to have a much lower percentage, only about 3.5% allocated to energy. So it still has pipelines in here, but it is going to get rid of anything with a low ESG score. And we'll kind of talk about it in a bit, that there is a cool new tool that we can look at these in terms of the ESG scores for these ETFs. But this would be an example of something that is both, if you did want some exposure to corporate bonds. Now, like in your mind, this idea of like 70% corporate, 30% corporate, 70% government, like, does that still make sense? Like, if corporate bonds, we're assuming that these are going to be the higher risk, or the lower risk ones, the higher rated ones, a little bit safer, that there is this government support from the central banks that is sort of like propping them up a little bit. That said, I think, really government bonds are going to be safer during this time. They are going to have a lower interest rate because they are safer. But like in your mind, and like if I can ask, like with your money, are you someone that would definitely have a mix of corporate and government bonds? And is this 70-30 measure sort of appropriate in your mind?
I think it's going to depend on each person. For me, understanding the dynamics of the corporate bond market, I generally feel a little bit more comfortable with that type of mix. But right now, that you're bang on with the trend, and I think there's a lot of what's called flight to quality out there. So there's a lot of interest in purchasing really, really high quality bonds. Province of Ontario, province of Quebec. Government of Canada bonds and the related issuers around there, they're all really, really highly rated debt issuing entities. So, I think there's a lot of support for those bonds out there. That said, the interest, you'll see it in the sense that those higher quality bonds have generally slightly lower interest rates attached to them. Yeah. So there's always a little bit of a trade-off.
And so just to show people, if I look at XGB, which isn't the cheapest one on the market, but these are all iShares, so it's kind of nice that like the layout's the same. We can see that just government bonds have actually rebounded more. So the government bond ETF up 6.69% instead of 5.5%. So it tells me the government bonds sort of rebounded a little bit higher. I think this would reflect to what you said, sort of that flight to safety. And then, but the weighted average yield to maturity, only 1.13%. So, this is going to be just government bonds. This is, you can see here, just provincial, federal, a little bit of municipal, very high credit rating, 51% AAA, 43% AA, so less single A, no triple B. So these are going to be safer. That they have actually outperformed so far this year during the crash with this sort of, flight to safety on the bond side, but you are giving up that interest rate. So, I think everyone's going to have their own thing there. Did get a question from Steve, and I just want to recognize from the chat that there was a question from Gail. And Gail, I'll get to you with these stock ETFs. We can get to that in the Q&A a little bit after the bond discussion. And June, I'm so glad that you're happy with that interest rate and bond value explanation. I know that's one that people often get stuck with, so hopefully that's clear. So Steve's asking, are there rules of thumb or recommendations for diversifying within a portfolio bonds allocation in terms of corporate versus government? I think what I'm hearing from you is that, probably makes sense to lean more towards government. That 50-50 would be a fine way of doing it. But, if you're starting to move more on the corporate side, you are taking on a little more risk. And so recognizing that. And then in terms of long-term versus short-term, I want to bring up the maturity. So let me just explain this concept first. That, when we buy a bond, it does have a very specific maturity date. So if I'm buying a 10-year bond that's giving me 2% per year from the government of Ontario, I'm going to hold it for 10 years. And at the end of 10 years, I get my money back. That bond matures. And the idea is that I would then need to reinvest that money. So at any point, any bond is going to have a specific maturity date. And there's a good chance that when we're looking at it, that unless it just got issued, that we're part way through that duration. And so we're often looking at how long is left on that bond until it matures. And so with all of these bonds, the ETFs that I've been looking at, and again, so the bonds inside are sort of like locked in, like it's like 10 years and there is that 10-year term. But with ETFs, because they're so liquid, you can buy and sell them whenever you want. There's no lock-in, but the bonds that the ETF holds, each bond is going to have a maturity. So this is the breakdown, 13% within the next 2 years, 9% 2 to 3 years, 17% 3 to 5 years, and then all the way up to about 24% of the portfolio is 20 plus years. So all of these bond ETFs are a mix of short-term, medium-term, and long-term bonds. My opinion has always been that, diversification is a good idea. That if I had really strong feelings about interest rates and which way interest rates were going to go, and I could get in the head of the governor of the Bank of Canada and consult that crystal ball, that, if I thought interest rates would go up, then I would want a shorter duration bond, because then it would mature faster, and then so I could reinvest it at a higher rate. If I thought interest rates were going to go down, then I would want a longer term bond, because then it's going to be more valuable because interest rates are lower. I'm glad I bought it when interest rates were still high. But personally, I'm of the opinion I don't really want to spend my time guessing interest rates. So I tend to prefer a mix of short-term, medium-term, and long-term bonds, and a nice sort of healthy mix of those three. Darryl, do you have any input on that? Are there these sort of rules of thumb in terms of short-term, medium-term, long-term?
Diversification. I think trying to pinpoint, kind of where interest rates might be going, and then selecting a duration strategy based on that. You might as well flip a coin. So I prefer, exactly as you're mentioning, just having a diversified approach where you do have some short-term bonds, you do have some long-term bonds in there. Awesome. It's really, I think, a impossible strategy for not just retail investors, but even for institutional investors out there to really have a good prediction of which way interest rates will go. So just having a mix, I think, spread it around and have a mix between both corporate and government bonds in your portfolio.
And in my mind, it's not a big deal if you just can't stand owning pipelines. Even in this ESG one, I can show you here. If I look at the holdings, there is still going to be pipelines in here, right? And these would be the higher ESG pipelines, right? And so, to me, it's if I look, let me just get it here, PepsiCo, TELUS, Hydro One, but here it is, TransCanada Pipelines, there it is. So there are going to be some pipelines in here. So to me, really, if this is a thumbs down, no, I don't want any. Unfortunately, with these ESG funds I haven't seen a fossil fuel free bond ETF, corporate bond ETF yet. So, so to me, it's just the solution. If you really don't want pipelines or any fossil fuels, do just government bonds. And I think, Darryl, we're on the same page that, that would be playing it a little more safe than you need to. However, in this environment with everything that's going on, that should be fine. Is there any concern around long-term like deficits and debt with governments? Obviously they're spending all this money right now. Is this something that we should be worried about at all?
In the near term, no. I think there was probably a little bit of a conversation as the crisis was unfolding. Okay, well, debt to GDP for any of these sovereign or sub-sovereign nations is exploding. That said, the interest rate to service any of this debt being issued is incredibly low. So any of these provinces or governments out there are able to issue debt to basically support the economy in the near term, and the interest rate that they're paying is in the kind of 0.4, 0.6. I think on the 30-year government of Canada bond, we're at about 1% right now. They're extremely low. So I think a lot of people get caught up on looking at the debt to GDP metric, the full amount of the debt compared to what's the economic activity. That is one measure to look at deficits and fiscal spending and ratings. The other aspect is also looking at the amount to service that debt.
So the interest payment
is extremely low right now.
And so right now with this low interest rates, it's bad news for investors. We're all grumbling at our low returns, but it's good news for taxpayers, knowing that, now this could be a time to implement a Green New Deal, or obviously the social programs that we have right now. This notion of how are we going to pay for it? It's well, interest rates are so low that now really is the time to invest in the future, both in terms of people and the planet. So I think that's good. Did get another question from Stevie, said, very helpful, thank you. Would it be safe to say that for an average DIY investor, an ETF that covers the universe of bonds would provide adequate diversification? So these are going to be this aggregate universe. When we look at the iShares, this Canadian universe, these are kind of the standard benchmarks, I think is what Steve is referring to here. And, in my mind, yeah, like this is why they exist. That's kind of why they call them universe, that this really one ETF is really the only thing you need. And it's a matter of just picking what is that one ETF. It has popped up before, and Darryl, I'd love your opinion. The idea of diversifying into international bonds, like with our stocks, we want to be globally diversified. That's kind of a no-brainer. But when it comes to our bonds, we're not. We tend to really stick in Canada. Can you speak to that?
There's a bit of an interest rate risk component to it. When you're invested in global bonds, you are subject to interest rates kind of on a wider basis, which is a good thing. And I think with globally diversified portfolios, it's a nice complement. Flip side to that is you also do have a little bit more exchange rate risk with some of these more global bond portfolios. So, it's a good thing. Just be aware that there are both Canadian dollar hedged and unhedged ETFs out there. We do find, and there is the tendency for corporate bond ETFs and lots of portfolios that I looked at for them to be Canadian centric.
Yeah.
So that's on the one hand, it does provide a level of support in the sense that you don't have this additional exchange rate risk embedded in there. But on the other hand, you are kind of stuck with the same sort of set of companies. It'll be your financials, kind of pipelines, telecoms, and government agencies in the portfolio.
Well, I mean, and there are some, like, let me just see if I can bring it up here. But there are some, for example, there is a green bond ETF. But the issue is that it's international and it does trade in US dollars. And like, just to give people an idea, the yield is like 2%. And, if I were to look it up, this GRNB, let me just do a summary. Your GRNB, that year to date, it's probably up, a little bit, but it is the type of thing where, because it's traded in US dollars, really the difference, what's happened in the gap between the Canadian dollar and US dollar, in my mind, would like dwarf all of the returns in terms of both the interest rate and that appreciation. So now in this case, it would have been good if you bought a US dollar bond ETF, having that currency risk. Well, guess what? The US dollar got stronger, the Canadian dollar got weaker. You would have won there. You might have almost like doubled up on your returns. But it's almost a coin toss that we don't know what's going to happen with exchange rates. That if the opposite happens and the Canadian dollar gets stronger and the US dollar gets weaker, that now all of a sudden we're in a situation where, any return we have from our bond ETF has just been wiped out because of that currency exchange risk. So, in my mind, it is really a good idea just to keep it with Canadian dollars. If you did want to carve out like a small part of your bond portfolio for, US dollar corporate ETFs, there are a couple of ESG options there, or, something like a global green bond ETF. It's kind of a nice to have, not a need to have. And, I would say that for most people, it really doesn't matter that, certainly you don't need to do that. It would only be something, if you really wanted to do it and you were okay taking that currency risk for this very low risk part of your portfolio. Do I have that right?
I would say so. Yeah.
Awesome. Cool. Well, I feel really good about this. I think this was a great conversation about bonds, and digging into the ETFs. Just want to throw it out to the chat. If you do have any more questions, happy to sort of stick to this topic. Otherwise, what I want to do, there is a little bit of a tool, a new thing that came out this week that I did want to show you that we can play with a little bit in terms of evaluating ETFs on the ESG side of things. So there's a new tool there. And then, Darryl, I think you're happy to stick around. Is that right?
For sure. Absolutely.
Amazing. So I'm not seeing any questions from the chat, so I think we're good in terms of the bond side. Oh, there was one last thing that someone had asked that I wanted to bring up, which is bond ETFs versus high interest savings accounts. This is something that with these bond interest rates so low right now, some people are like, Tim, should I just keep it in cash? My sense on that is that, it's really a coin toss, that if you can have one of these high interest savings account that's paying you like 2% or whatever, sure. But the issue is that with the bonds, or sorry, with the cash account, that you're not getting that inverse relationship, that inverse correlation to stocks. So if there is another crash, your cash isn't going to be worth more. It's not going to go up in value at all. And then also there is going to be the fact that you're going to have to transfer the money into your online brokerage account. So, if your money is already in Questrade or Qtrade or whatever, then you're not going to want to like pull it out and pay a fee to like move it over to this other institution and then like pay a fee to move it back over into the online brokerage. So, there's sort of that element. And that also there are these high interest savings ETFs. So there's like C-Save is one, and the other one is PSA. ETF, and these are like high interest savings ETFs, and the rates on these are just like so low right now. Like C-Save, when I look at it, 0.75%, right? And then there is a little management fee of 0.14, so you're getting like 0.6% on the net. PSA, which is from Purpose Investments, kind of the same thing, 0.65, and the management fee of 0.15, so we're only getting 0.5%. So, my sense is that if your money is like in a high interest savings account, maybe like leave it there, like until you're ready to invest it. Like you're going to have to transfer it at some point, but you might as well leave it. But otherwise, if your money's already in an investment account, you probably are better off with a bond ETF rather than one of these like high interest savings ETFs, just because that interest rate, will still be a little bit higher, even though they're both really low. And you will get that added diversification, that sort of buffer that, if there is another crash, we would expect, interest rates to drop even more. They might even go negative. Who knows? Well, that would be a fascinating conversation to talk about negative interest rates, but it could happen. And of course, that would push the value of our bonds up. So, Darryl, any thoughts? Do I have that right? Are there any thoughts on this sort of high interest savings versus a bond ETF conversation?
Only the one other thing that I would add, and I've kind of been saying this for a couple of years now, shockingly, is that GICs are still actually, they're actually kind of in right now. They're not too bad at, for 2 years or 3 years, you're in the 2% range.
Yeah.
Benefit with a product like a GIC is that you can have this type of like static return in your investment account. With a high interest savings account, it's a little bit kind of cumbersome to have it off to the side. I think high interest savings accounts are great to park money for emergency expenses, to have it on the side, which I actually didn't get on my kind of like pro have your emergency expense 3 months, 6 months, whatever spiel. But GICs, high interest savings account, and just, plain old bond ETFs, they all have a place. I think they're all really good options. And they do things slightly differently. But I would definitely say that there's no major advantage to one versus the other. Like you said, if we start to get interest rates that slide even further, which is definitely possible, your corporate bond or your government bond ETF is actually going to give you your existing interest rate plus a bit of appreciation, whereas something like a GIC or a high interest savings account won't. So there is that negative. That said, if the converse happens, if rates start to go up, your corporate bond or government bond ETF is going to have a little bit of a drag on the total return, because the prices for those bonds will start to perhaps erode a little bit, like we mentioned earlier. So there's a little bit of, again, not a cop out, just talking about diversification and the importance of having different products and different strategies in your portfolio.
And so, my understanding is that GICs and high interest savings accounts, those would be considered uncorrelated to the markets, that they're just not going to budge no matter what the stock market does. They're just going to keep humming along. Whereas, the bonds, the reason we like having them is that negative correlation, that they're going to go in the other direction. I do have a website up here. I don't know where you shop around for GICs, Darryls. I've got this highinterestsavings.ca/GIC rates, and that tends to be pretty good, but like People's Trust, a 1 year 2.1%, 2 year 220, 3 year 230, 4 year 230, 5 year 240. So, you do get a bit of a premium by having a longer duration on it, but that would mean that, the risk of sort of interest rates going up, and, that obviously there would be a better place for your money if you did that. So, I would like the idea of sort of sticking probably to 1 year GICs for now. and and then maybe even like, if you wanted to do it over the longer term, you could like build a ladder. So you could, sort of do like, 10 or 20% of your money into the 5 year, and then just do that every year for 5 years. And then that way, part of your money would come due every single year. So, these are different ideas, in terms of that very low risk part of your portfolio. But really, I think the takeaway here is that whether it's a bond ETF or a high interest savings account or GICs, that really it is still important to have that as part of your portfolio. I would say at this moment in time, for sure, just as the market does, get more confident, and the stock market does go up, and that really it's a bit of a personal preference between those three different vehicles to figure out what's the best thing for you for that low risk part of your portfolio. Perfect. Okay.